Okay, now we're gonna learn how to do exercise 16, just walk you through it real quickly. Again, the task here is kind of twofold. First of all, you need to figure out some actual data about taxes being paid, but then you're meant to sort of explain some of the significance of that in terms of, well, economic content. So here's how I've got it set up. Here's the data. So you've got 5 different income brackets, and I've got them going from lowest to highest, and there's a reason for that, even though it's different from your book, I think you'll see. Secondly, here's the problem. Now, essentially the problem is to fill out this whole table, this extra table that I've made. So, not only are we going to figure out the income tax paid, but we're going to figure out some things about marginal and average tax rate, as well as sales tax paid as a percentage, and then look at how that is the percentage of the income. We won't get to that for a while though, all right? Let's start here. Let's start with the income tax paid, and that's again the most basic task, and that's the building blocks of all of this. So the reason I drew this from lowest to highest is you need to think about when someone earns money, that basically the money they earn goes into each one of the levels, and then once they move beyond that level, it starts to fill up the next level. So we see that Sarah here that's in green, she only makes 16,000 euro. So the first 5,000 she makes goes into the 0% bracket. So it gets paid 0 tax. The next 10,000 that she makes goes into the 5,001 euro to 15,000 euro, and it gets taxed at 5%. And then the rest that she makes, the additional 1,000 euro, it goes into this next highest tax bracket. Okay? That's no different for Rebecca and for Sanjeet. Okay? The first 5,000 they make goes into the same exact bracket and it doesn't get taxed. The next 10,000 they make, for all 3 of them, gets taxed at the same rate. Okay? The differences only occur when they move beyond the previous one. All right? So let's figure these out real quickly. Well, this one obviously, 0% of anything is 0, so this works out to be 0. That's simple. Okay? So we can say for Sarah, her income tax paid is going to be 0 plus, as well as for Rebecca and for Sanjeev. The next level they get into, well, that's 5%, and it's 5% of 10,000. Remember, even though it's 5,001, that first dollar gets taxed as well. I'm sorry, first euro dollar. Okay, so this is $10,000, and 10% of 10,000 would be 1,000, so half of that is 500. So this, for all 3 of them, is 500 euro. Okay, so this is 0 plus 500 for all 3. Okay, so they're all the same at this point. Okay, now we get a little bit of variation. For Sarah, she only has $1,000 that gets into this third bracket that gets taxed at 15%. Okay, so she's going to be 1,000 times 0.15, so it's going to be $150. Okay, so she's 0 plus 500 plus 150, so her grand total is 650. Okay. For Rebecca and for Sanjeev, their totals are going to be a little bit different. They have a full $15,000 that gets taxed at 15%. Okay, so that's going to work out to be 2,250 euro. And again, I can predict real quickly if I want to do the math in my head. I can say, well, 15% is 10% plus 5%. So 10% of 15,000 is 1,500. And then 5% of 15,000 would be half of 1,500, so 750. 1,500 and 750 equals 2,250. So they're both going to pay us their third number plus 2,250. Okay? And then they're not going to get variation until this last tax bracket. And in this last tax bracket, they're both going to pay 30%, but they're going to pay 30% of different amounts. So they're going to pay 30% for Rebecca. She's going to pay 30% of $2,000. That's the excess. So again, 10% of 2,000 is 200. So 30% would be 3 times 200. So Rebecca's going to pay 600. So this is going to be her last number. Sanjeev has got 18,000 that goes into this last bracket. So that's going to be a little bit harder, but we're going to do 18,000. And 10% of 18,000 would be 1,800. We can just move the decimal one to the left. And then 10% times 3 is 30%, so we can take this number by 3 and get our correct answer, which is going to be 5,400. Okay, so her last number is going to be 5,400. Okay, so we just add these numbers together and we're going to come up with a total. So here are our totals. Now, the next box asks for a comparison of marginal tax rate and average tax rate. Well, the marginal tax rate is just the tax that they paid on the last dollar they earned. So it's the highest tax that they paid. Okay, so for Sarah, she ended up here, so her marginal tax rate is 15%. The other two ended up in this bracket, so their their marginal tax rate is 30%. For average tax rate, now what we're going to do is take this number that we just calculated and divide it this column with this column over here. So for Sarah, we're going to say 650 and divide it by her income, which was 16,000. Okay, do the math on that real quick. For Rebecca, it's the tax she paid, $3,350. Divided by her income, 32,000. And finally for Sanji, it's 8,150 divided by her income, which was 48,000. And that's going to produce the average tax rates for each of those three. So we see that these work out to the following answers there. That math produced these answers here. So to figure out if this tax is progressive or not, which is one of the questions you're asked to answer, you have to compare marginal to average tax rates. And we can see in all of these, the marginal tax rate is greater than the average tax rate, which means this is a progressive tax. Okay, and again, you can see that mathematical relationship just right here, that if marginal tax rate is greater than average tax rate, it has to be progressive. If they're equal, it's proportional, and if it's reversed, then it's a regressive tax. Okay, speaking of regressive taxes, we can oftentimes argue that sales taxes, even though they're technically proportional, that they can actually work out to be regressive. So to show that, what we did is we took 20%, a 20% tax rate, and applied it to the goods and services that each of these people buy in a year. And quickly to notice what's going to happen here, if you compare the goods and services to the actual income, what you'll notice is that these two guys, well, the ratio that they have, that they're spending, is actually the exact same. And they're spending most of their money on goods and services, so they're saving very little. This person, Sanji, we can see that they're saving or not spending on goods and services a much greater proportion of their money. Could be saving, could be investing. It could be that you've traveled to a foreign country, so you're not paying sales tax in the country that you're talking about. Anyhow, thinking of it as savings is probably the easiest thing to do. So once we've done that, once we've looked at that, then you can go, okay, well, 20% of each of those numbers works out to 3, 6, and 8,000. And then you can take that number and apply it back to their original income. So if we look at that number, their sales tax paid as a ratio of their original income, you end up with the numbers that we see over here on the left. So as a percentage of income, we see that actually Sarah, even though she makes the least amount of money, and Rebecca too, they both actually pay a smaller percent of sales tax when it's made a percentage of income. So now we can say that in looking at it in that way, that the person who has the highest value of income, is actually paying a smaller percent of sales tax. And in that way, we can argue that a sales tax is regressive. It's a big concept in economics, and there's a lot of arguments on either side, but the argument is definitely out there that sales taxes can be seen as regressive taxes.